Hey everyone, it is Ian, and I'm back with another video today, guys. And I think you're really going to enjoy the concept that we're going to cover because we're going to be incorporating not just some of the fundamental information that we've discussed in the past, but we're going to also be taking a look again at some earnings trade ideas, and we're going to be delving into the topic of illiquid options and when it might be best to take and not take an illiquid options trade and how we can measure when it is a good or bad time to take said trade using tools in the predicting alpha terminal. So, guys, without further ado, let's get started. I'm going to save that last bit for the end because obviously we need to go through the trade first to see if it's even worthwhile taking. And the example that we're going to use is on Cal-Maine Foods Incorporated, ticker symbol CALM. This company reports their earnings tomorrow, December 28th, after the market close. Now you're going to notice that they don't have weeklies, and we're going to discuss this as well a little bit later. But first, let's break down why we're even considering this looking like a pretty optimal trade. So again, search up Calm, refresh your data. Currently, what we have is we have an implied move of 5.78%, which is the exact same as the average implied move. We can also see the implied move versus the average move is at 1.93. Now, it's important to note that this is a bit of a more illiquid options chain as indicated by this number right here. However, I checked things from the lick actually looks a little bit better than this, so I thought it would be a great idea to give an example. But when you have less liquidity, right, it takes less to move something. For example, let's say I own a company and we sell crayons, right? And the market cap of my company is $500, right? If someone comes in and wants to buy a share of my company for $100, assuming it's on the open market, this is gonna, push my price up, right? It's gonna cause a ton of upward pressure in my delta, right? In my stock price, right? But if that same person took $100 and they bought, shares of Apple, right? Market cap of over 3 trillion, not really going to do a whole lot. So what this causes is it causes a lot of whiplash and seesawing, which can make it difficult. But I really wanted to make an example as to why you're seeing these numbers kind of fluctuate back and forth. But the general range is nevertheless overpriced relative to the historical averages, right? Which is always a good sign. We always like seeing this, right? Now, the next thing that I'm noticing is we have a straddle P&L of below negative 200%, which is great. We love seeing this, right? You love to see it's like, okay, this is great. It's implied it's above the average. That's awesome. But what if it's like, a Snapchat and it's just getting blown out and its teeth are getting kicked in every single quarter and people are losing thousands of dollars on this trade? Well, that's a little bit different. Now, what we can see though is we don't have to deal with that dilemma here, guys. This seems like there's a lot of consistency here. And these options are consistently overpriced heading into earnings events. Next, we can see on the moves that this basically has been mostly due to a couple of events that occurred back in 2019 going into 2020 when they had two volatile quarters on the earnings calls. But besides that, we have not seen this case throughout the rest of its quarterly earnings cycles up until today. This seriously has not yielded a profitable P&L buying straddles um into the earnings since 2019. So, what does this all mean, right? What does this cultivate here? Well, it cultivates a couple things. One, it kind of shows to me a couple things. Being the options are less liquid, that there may be less eyes on this, right? And when there's less eyes on something, there's a lesser chance it's efficient. For example, look at the Forex market, right? The Forex market is extremely efficient because there's a ton of money there. It's very hard to find anything that is overpriced or underpriced. Now, that's a little bit different with liquid options, right? Like the options here, I would argue, are probably going to be more wildly quoted and over or underpriced more frequently than on something like Apple, right? Because Apple is super liquid. So seeing something like this shows that, hey, maybe there's a bit of a niche here. Maybe a lot of people aren't looking at it. Maybe we can trade this. So how do we go about structuring that? Well, a couple of things, and we're going to take these off bit by bit. The first thing you're going to notice that structuring a trade on this is just like structuring an earnings trade on any other. Only difference is we do not have weekly options here. So what does this mean? Well, just like with, if you're trying to sell short dated vol and get gamma exposure, you're going to sell the closest options to expiration. It's the same with earnings. You want to sell the closest dated options to expiration. So that'd be the January 20th of 2023 options here. Now, does this mean that we're going to be getting more earnings event exposure than, say, a weekly option? No. I mean, we're not going to get the same amount, right? You can notice this because this is pricing in, get relatively speaking, what we should expect after the earnings event. And you're going to notice that this purple line, which is what it would be on the given date, right? December 29th, 2022. This purple line is nowhere near this blue line, the max value that could be collected, right? The reason is because these options have more non-earnings event days till expiration that they're going to see, right? So there's a lesser dependency on the value of these options pinned by that event, right? The event doesn't make up as much of the overall volatility pie between now and expiration as it would for, say, a weekly option. So that is the first reason. So does that mean that there's nothing here? Not necessarily. If we go back to the predicting alpha terminal, and I may have to actually refresh this, guys. Sorry about that. Give me 1 second here. Please do not steal my login info or my email. But anyway, yeah, going back in here, if we go to the relative value tab, there's a really neat thing that we can do. If we type in calm, right? And I'm gonna use the non-event IV20 because it's actually relatively close to where we are today. If we go back here, you will see that actually. So if we go back here, you'll notice that these options expire in 24 days. Non-event IV20 gets us really close to what I'm about to show you, which is non-event IV20 is around 32.26 vol. So if we go back here, this is give or take what we have when you make some adjustments and you subtract 34 at 29, etc. So what we have now is we can get a forecast of what we would expect on each given thing. So this right here is give or take where the stock is currently at. This is its average move. These are our break-even points, right? So we can see that if this realizes the average move, right, we can make over, anywhere on average between 120, 140, $100 per bet. That's great. It's a pretty solid risk reward considering this is just a premium marketing strategy. So with that being said, right, there still can be edge in, selling options that are not weeklies on earnings, right? Now, the thing that comes into play though is this looks great, right? Let's go back here. This looks great, right? Calm looks excellent across the board. Looks excellent, right? Historically negative returns, historically consistent premium. This is what you want, right? Why is this here? One of the reasons I think it is, guys, is because of this, right? The liquidity is surprisingly good, which is why I wanted to make this example here. And I think a lot of the reason these options are being traded this week is because of the earnings event that is coming around. But typically, these options do not appear to be all that liquid, right? I mean, we're talking about volume of 3, volume of 71. This is not great, right? And compare that to, say, something like Apple. You're going to really see what I mean here. I mean, we're talking about volume in the thousands, right? Volume on the 130 put contracts here expiring at the same date are trading 9,000. There have been 9,728 of these contracts being traded just today, right? If we go back to calm, the same at the money put options, right, are only getting traded 67 times. Right. We can also notice something. There's a lot of calls being bid up, which could go into some analysis that I'm going to get to with the fundamentals. First, I wanted to make this point about liquidness. This could be a reason as to why, right? Overall problem here is that these spreads and the overall liquidity is low. Spreads are high, liquidity is a little bit low. These spreads actually have come in. This is actually really nice. That's actually really nice. I will make a point. This does look good. That's a little wide and wonky. Again, this is I'm going to say it one last time. This is a real big reason why I thought Calm was a great example because it doesn't show a super extreme condition because there will be more experienced traders in PA that will tell you that you can see spreads that are double the width, right? So you can have like a $3 bid and a $6 ask, right? It's ridiculous. So how do you go about trading that, right? Like I have my straddle on, that's great, but I mean it's all I mean like if I'm getting filled at the bid price, then this isn't ideal. So how can I measure what I'm getting filled at? Measure what vol I'm getting filled at too, because after all, we're selling vol. It's very important. Well, a couple ways we can do this, guys. Number one, I'm gonna have to do this again. Sorry. Number one, what we can do is we can actually use the options calculator in the PA terminal to delve very deep into this. Right. So if we go to the calculator and we go to the implied volatility calculator, we can actually price out what vol we get filled at. Right. So if we go back here, right, and let's say we're looking at the 65 put contract, right? The right to sell it's at 65, obviously. So we have 350 and $3. Now, could we just go for if we were trying to get filled and just go, yeah, we're just gonna sell it in mid? We could. But let's say the market maker won't fill us in mid. The market maker won't fill us at 325. What if he's trying to walk us down to say, 310, 320? Well, you know what we can do? We can see what vol will get filled at by using the calculator. So we currently have an underlying price of $64.15, right? Our strike price is $65. Our expiration is January 20th. Our market price, so the price that we are forecasting to get filled at, let's say it was 310, like I said, on this put option, you're going to see that we're going to get filled at 40.2, 0.042, right? So it's currently at 40.63%. This selling at 310 would get us down to 40.2%, right? Conversely, if we sold at, let's say, just 3 and we just sold the bid, you're going to notice this comes down even further. And obviously, if we sell the ask, this rises significantly. So if you were able to sell the ask, that'd be great. But more times than not, that is most likely not going to happen. Now, one last thing I want to touch up on with the liquid options is, these take a lot of time to kind of really master and harness and lock in. I really just want to show you guys the tools so that way you can know if you're getting skinned, right? If you're getting skinned on, by a market maker on the spread, right? Because if you just go in and you just sell the bid price here on a given straddle, that could happen. So one strategy you could do is you can leg in. Right, that's one thing you can do. You can leg into these so you can sell your call leg, right? Let's say, these spreads were let's say for whatever reason the call spread or the calls bid ask spread was tighter than the puts bid ask spread, right? And we came over here, which it actually is right now, which is interesting. But anyway, on the left side, let's say we just want to get our call filled at 230, got filled there. Now we can come over to the put side and get filled at, let's say we're shooting for 320 over here as well, or over here, sorry, at 230 and then 320. Sorry, that's a bit of a tongue twister. But nevertheless, there's a multitude of different strategies to do. We can cover this more in depth. Really just wanted to introduce you guys today to the subject of the matter and how you can use the calculators in the predicting alpha terminal to actually figure out what you're going to get and what vol you're getting filled at when you make said trade. And also I really want to show you guys the non-event IV20 because or 9 event IV30. It depends on obviously the expiration. Just because this really can show you what your forecast volatility is going to be post event on non-weekly options. So the last thing I wanted to talk about, guys, is the fundamental analysis, right? I know that I mentioned this point in the beginning of the video about there could be a reason as to why we're seeing this premium again occur this quarter. And it centers around the BLS, right? And the BLS, basically the BLS obviously releases the CPI every single month. And yeah, I mean, I took a look at this and it's extremely interesting and telling because if you actually scroll through and you go down and look at the um prices for eggs, these have risen significantly. I mean, significantly. Like, I'm not just talking a little, I'm talking egg prices up are up over 49% year over year. In If we go over here and look from in the month of November from compared to October, they increased by 2.3%. And the quarters, right? The quarters that um Calman are going to report for, right? So that's going to be November, that's going to be October, that's going to be September. We can see that first in September it decreased by 3.5% before rising by 10.1% in the month of October and 2.3% in the month of November. So this could lead to is a huge increase in the EPS forecast, which is actually what we're seeing on the Nasdaq. The Nasdaq is forecasting an extremely high EPS of over $4 compared to what it reported last quarter, which I believe was $2.57. So it's a massive, massive increase, and that could lead to a multitude of factors. I mean, obviously, when it's more volatile, maybe these analysts are not as susceptible to getting the numbers right of where they're going to be, and obviously that could lead to a higher premium. So thought I would really show you guys that again how fundamental analysis can be used sometimes to better understand why something might exist on a particular trade. So with that, guys, that is all I have for this one. I really thought this we would just introduce the concept, introduce a couple ways to take a look at it. Um, if strategy wise, I typically try to always to start at the mid and just walk down the market maker. But obviously, it gets to a point where, it's not worth trading, and that's fine, right? If the market maker is like I'm only gonna buy this a bid, right? And I run that through the calculator and it's not a good fall to sell it, then I don't do it, right? And that's the thing, guys. Not every trade you need to take. No one's making you take it. So always keep that in mind. And some people have their own different strategies. So, maybe you find something that works for you. I highly recommend just studying it and trying to practice it. I really wish that paper trading on TOS wasn't instafill, because if it wasn't, this would be great to practice on. If it actually used like real quotes. I don't know if it does that entirely, but nevertheless, practice this, study. If you guys have any questions on this, feel free to message me or reach out into the Discord channel, because I am willing to bet that someone has experience in this as well. So, yeah, that's all I got for this one, guys. I really hope you enjoyed it, and I will see you in the next one. Peace.